Hello everyone, I am Dr. Soundararaj. I am very happy to interact with you all through this video. In this video, I am going to deliver my lecture on the topic Profitability Index and Capital Rationing. The concept of Profitability Index will be explained using a practical problem. These are all a couple of details related to my career. After you watch the video, if you find the video beneficial to you, give a like to the video. Then do subscribe my channel and enable the notification button as well so that you will get the notifications of my future videos. Profitability Index. It is the ratio of the present value of cash inflows at the required rate of return to the initial cash outflow of the investment. So this ratio represents a relationship between total present value of cash inflows of a given project with the cash outflow of the same project. And that is what about the meaning of profitability index. Profitability index perhaps is one of the discounted cash flow methods of capital budgeting. The proposal is accepted if the profitability index is more than 1 and it is rejected in the case the profitability index is less than 1. Let us look at the formula for calculating profitability index. Present value of cash inflows in total divided by the cost outlay of the project will give us the profitability index of the project. Let's get into a problem. The initial cash outlay of a project is 50,000 rupees. Estimated cash inflows for 4 years from the project are 20,000 rupees for the first year, 15,000 rupees for the second year, 25,000 rupees for the third year, and 10,000 rupees for the fourth year. So, to calculate profitability index, we are going to make use of the cash inflows and cash outflow of the project. Fine. Compute profitability index. Let us look at the table prepared here. The first column stands for the years of the project and the second one is about the cash inflows. The third one is about the PV factor at 10%. Perhaps the PV factor should be mentioned in the problem itself. When you get problem related to the calculation of profitability index in your examination, the discounting factor or the present value factor percentage will be given in the problem itself. So make it very clear. Fine. So PV factor at 10%. These present value interest factor values have been chosen from PVIF table and that are presented here for 10%. Now, they have multiplied the cash inflows with the respective PV factor for each year and calculated the present value of cash inflows for each year. For first year it has come to 18,180, for second year it has come to 12,390, third year 18,775 and the fourth year 6,830. These are all the present values of these cash inflows at the discount rate of 10%. The total present value of cash inflows of the project at 10% comes to 56,175. Now let's look at the calculation down here. Total present value of cash inflows comes to 56,175 less initial cash outlay 50,000, you get the balance 6,175. This is what net present value. So here they have calculated net present value also. However, this has not been asked for. We will make use of only these two figures to calculate the profitability index. Because profitability index represents a relationship between the total present value of cash inflows of the project and the total present value of cash outflow of the same project. That's what. But in addition, they have calculated net present value also for the project. It is positive. Now, profitability index, present value of cash inflows divided by the cash outflow. That means present value of cash outflow of the project. 56,175 divided by 50,000, it gives us 1.1235 profitability index. Since this answer is greater than 1, the proposal or the project can be very well accepted. Now, what's the meaning of capital rationing? Capital rationing may be defined as a situation where the management has more profitable investment proposals requiring more amount of finance than the funds available to the firm. So, in this situation, what we can understand, in front of a business enterprise, there are many profitable projects available, but the issue with the business enterprise is that it doesn't have adequate funds to invest on all the profitable projects available in front of it. And that's the issue. In such a situation, the firm has not only to select profitable investment proposals, but also to rank the projects from the highest to the lowest priority. In case we find there are 5 profitable projects available in front of a business enterprise, but it has got funds to invest only on 3 projects. So what you could do based on the capital budgeting technique you have made use, you rank the projects based on their profitability, and now you can choose the projects with the first 3 ranks and do your investment. In case your financial resource is limited or it doesn't permit you to invest on all profitable projects available for your concern. This is what the meaning of the concept capital rationing. It's a table, fine. From this table only they have picked up the PV factor at 10%. This is table number 1, which stands for PVIF, present value of rupee 1. That's what the idea behind it. I hope I have done my explanation up to your level of satisfaction. Thanks for watching this video. I'll meet in another video. Bye for now, everyone.